Hello and welcome to yet another edition of Fraud Friday, where I discuss ethical issues. Today, my big question is, why are mutual fund share classes still a thing? Now, most of you probably know this, but for those of you who don't, there are different share classes for mutual funds. There are at least 8 that I can think of. Of course, the most famous or well-known are probably your share classes A, B, and C. I is often an institutional share class. R is often the same thing. The big differences are in terms of fees. There can be front loads, there can be back loads, there can be no loads, there can be 12B1 fees, there can be management fees, and other types of expense fees and ratios. Oftentimes, different people have different access to different share classes. Institutional owners often have access to more favorable fee structures than retail investors. I leave it to you to research the actual differences between each of these share classes, but needless to say, there are differences mainly in the fee structures. I want to say that I do believe that broker dealers, investment advisors, asset managers, they all deserve to be paid or compensated for their services. They are providing you with expertise that you should pay for. That is not part of my gripe here. My gripe is in terms of conflicts of interest. It's not always clear cut. You want to receive advice because it's advice that is good for you, not because the advisor gets paid a higher commission if you invest in that investment. This is a problem. Being legal does not always mean it's ethical. There are easily conflicts of interest built into this process. I should say, there are times when this conflict can be occurring in your subconscious mind as an advisor. You don't even realize that there's a conflict of interest built into your recommendations. I have a nice little presentation about your subconscious mind influencing your decisions in terms of analysis. You should check that out here. It's a nice little video. And finally, you should look at this article here, which kind of inspired this piece, where the SEC is fining an investment advisor because they were offering mutual fund share classes that had a 12B1 fee in there when they could have offered a share class, the same investment with lower fees. They got compensated more for recommending the one with the fees, and the client was worse off because of it. What I'm advocating for is full transparency. I think we should have broker dealers, investment advisors all get paid, but the more transparent this is to the investor, the better. Simple as that. Also, what I want to say is I want the solution to be good for all parties involved. I want the investor / client to be better off, or I want the advisors, the asset managers, the broker dealers, all to be compensated in a fair and reasonable way. Now, I should say that one of the things we should consider is the assets under management. If we go by simply a percent basis, maybe you're not paying as much when your assets are low, which maybe is reasonable considering maybe the long-term growth of your wealth. But at some point, if you have $1 trillion, you don't need to be paying your advisor $1 million a year in advisement fees. So there needs to be some sort of transitional structure to these fees. In the end, again, it needs to be fair and reasonable to all parties involved. You pay for what you get, and you get paid for what you give. Ultimately, I think there is a better path forward than our current system. I think we need to think about that as an industry. Consider, again, is it fair and reasonable to all parties involved? Thank you so much. Have a good day.